On today's special Happy Birthday America show, one question. Yes, only one. What do you need to know about the deficit? Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
And I'm Rabih.
Yeah, you are. There's only two of us today.
Yep.
And happy birthday, America.
Woohoo!
Rabih, I know this is truly, like really special for you. This is your second 4th of July as an American citizen.
Yes.
You don't take it for granted. You help me not take it for granted of how amazing we have it in America. So, and I really do appreciate that about you, of just again, helping me realize how grateful I should be, and I am, to live in such an incredible country. So happy birthday, America. Happy 4th of July, everyone. This is coming out on the 5th, but it's the week of 4th of July, so exciting. Rabih, we figured we would do one topic on this today because we realized as we were going through this just how much there is on this topic. So we kind of wanted to change it up a little bit for this. What better to talk about on America's birthday week than
financial health.
It's financial health and the deficit and the debt and all this. So
that's what advisors do.
It's what we do. Yeah, it's what we do. So we wanted to do a deep dive episode. And so we did just one question. There's so much here about what you need to know about the deficit. And I think this is so good because I think this is something that gets so confusing for people. I think this is something that we hear a lot about on the news, and we hear, things like deficit and debt. But I think it's one of those things that people don't often want to raise their hand and be like, I don't really know what this all means. So I think this is a good opportunity for us to kind of dive in a little bit, help people understand the deficit, what the difference between the deficit and the debt, how it all works. And we're going to do our best to liken this to a dental practice and use that as an analogy, and give some basics, and then talk about where we stand as a country with the deficit. And I think the biggest thing here, the lens we're going to look through is this as bad as people make it sound? I think we're going to try to navigate the noise, as they say. So let's jump in, Rabih. What do you need to know about the deficit?
Yeah, this is exciting, and it couldn't be any more timely. It's America's birthday, so we have to talk about this, as you mentioned. Also, like last week, we had the presidential debate. It's an election year. These terms are going to be thrown out a lot. People would want to refresh their memory so they can actually understand what they're talking about. So yeah, we're going to talk about deficit. We're going to talk about debt. We're going to talk about their components, where we stand, and let us just be financial advisors and assess the health.
Okay. Let's just be nerdy for a second, all right?
Let us just be nerdy for a second. So let's start with basic definitions: deficit versus debt. Deficit is the negative net cash flow in a single year for the government's budget. So every single year, the government has certain amounts of revenues coming as inflows and certain amount of expenses going out as cash flows, outflows. In a year when the government spends more than it makes, it puts the budget in a deficit. And this is what we call a deficit. It's the negative net cash flow year over in a certain year.
So if this is a dental practice, you're looking at your P&L, it's a year-to-year situation. You might be in 2023, you ran negatively, you had more outflows from your staff and from all your expenses than you brought income and from collections, your negative cash flow. The next year, you might be positive. It changes year to year. That is the deficit. It is a year-to-year metric of cash flow.
And because you spent more than you made, that difference between them, you have to borrow it.
Which then builds the debt.
100%, which builds the debt. But on the flip side, if you are making more than you are spending, you are in a budget surplus. And this is the equivalent of you actually making a profit in your business year over year.
Yep.
So as we said, a deficit is the negative net cash flow. The difference has to be borrowed. And as those deficits accumulate from one year to another, and you look at them cumulatively, that is your outstanding debt level. So when we say, the U.S. economy has a $27 trillion of U.S. debt, it's an accumulation of so many deficits across the year that have now reached this point. Just to give you a reference, last year, 2023's deficit was $1.7 trillion. So out of the $27 trillion of debt, 1.7 was part of it and it was added last year, and it is continuing to grow.
Rabih, I think you're going to hit this. So if I'm jumping ahead, tell me, when's the last time we actually had a surplus?
Oh yeah, let me pull up
from like an actual like positive cash flow in America.
Okay, yeah, let me put it up. So the only years in the past 50 years where we actually had a surplus were years 1998, 1999, 2000, and 2001. In a percentage of GDP terms, they are very small surpluses. So like your profit rate wasn't really high. It was a 0.8% of GDP surplus, 1.3%, 2.4, and 1.2. Those were the only years where we had a surplus in the last 50 years, which is just tells you of how much of a spender our government is.
Yes. That's 50 years. 50 years we've had one run of about 4 straight years of a surplus. Other than that, we've been running a deficit.
Yes.
So 46 out of 50 years.
And in the past, since like post 2007, the highest deficits occurred. Mainly 08 and COVID, where the government had to intervene.
Yeah.
Okay, so before we go into analyzing those, I just wanted to break it down to you, because when people say, okay, so the budget is in a deficit, it has certain amounts of revenue, certain amounts of expenses, what are they? How are they broken down? So let's look at the expenses, the outflows in a sense. And we're going to look at them as a percentage of GDP, because GDP is changing year over year, and like a dollar amount will be a little bit confusing. The government categorizes all its expenses onto 3 categories. Just like a dental practice, what would it have on its expenses? Overhead, and the overhead, and then marketing, and
so marketing, supplies, their staff. Yep.
100%. So the government has 3 main categories. They have a mandatory category, they have a discretionary category, and a net interest category. In the mandatory, which is around 14% of the GDP, we've got Social Security, Medicare, Medicaid, like income security programs, and other stuff.
So you said mandatory. These are things that the government has to pay no matter what. They're part of the law. Like those are the entitlement programs. They're paying no matter what.
It's interesting. They are called mandatory for a reason, because the government has made an obligation to pay them out. It has made a promise to its constituents, to the citizens. The discretionary ones are actually non-defense and defense. And if you think about it, it's like infrastructure projects or paying money to grow the army. Though the government did not make any promise that, I need to pay the army every single year. It's just according to where they stand in the global terrain and how much they want
their office as well.
Who's in office, whether there are wars, etc., will affect how much they would want to allocate to defense, for example, or infrastructure in the technology race, etc. So this is what goes into discretionary. And I think the most important one in recent days is the category related to net interest. So we said that every single year you create a deficit, you are accumulating debt and you're adding debt. You're creating a pile of debt. And net interest is the interest expense that you are paying in your example 2023 for the debt that you have taken in previous years, because you can't just take on debt and forget about it. You have to pay interest on it. And that interest is the interest you're paying on previous amount of debts, and you're paying it in the current year of the deficit.
Yep.
Just to give you a percentage, so all of the expenses are like 22%, 23% of the GDP. This is how much our expenses, and the revenues are like 17% of GDP. So you can see what the deficit amount is. It's around 6%. But out of the 6%, 2.4% of it is net interest. So a third of all the deficit that we go into every single year, a third of all the new debt that the US economy goes into every single year is allocated just to pay older debt, just to pay interest. It's not to expand. It's not to provide benefits. None of that.
So what I'm thinking of here is the idea of opportunity cost. Like the larger that number becomes, that's less money that is going towards, like you're saying, expansion of the economy, actually growing the economy. It becomes literally an anchor on the economy because we're paying off previous debt that's accumulated over the years. But just to make sure I understand the numbers, you're saying 2.4% of our
GDP
is going towards that net interest cost.
100%, which is a third of the deficit, the most recent deficit.
Got it.
Okay.
Okay.
Now, those are the outlays, those are the expenses, and they are more than the revenues. But let's look at the revenues. Like, what are the sources of revenue that come into the Treasury Department?
Really quick, Rabih, can we back up really quick just to make sure we're hitting the numbers again? So you're saying as a percentage of GDP, we've got three categories that go into this these expenses or this deficit.
This is what the government spends money on.
Yep, mandatory. We've got discretionary, and we've got the net interest. A percentage of GDP on mandatory again? 14%.
Percentage of GDP on mandatory is 14%.
And then what about discretionary?
Around 6.5. And then net interest 2.5.
Got it.
So the three of them add up at 23% of GDP. So every single year, the government is spending around a quarter of our GDP's worth.
Got it. On these three areas.
On these three areas.
Cool.
In terms of revenue, actually, it's only 16.5% instead of 23%. So every single year, the government makes revenue equivalent to 16% of the size of the GDP for that year. And it has, I'd say, 3 or 4 categories. One of the categories is like other, 0.8. So it's not significant. But the other 3 main ones are individual income taxes, payroll taxes, and corporate income taxes. And in terms of a percentage of the GDP, individual income taxes as a source of revenue for the Treasury Department, for the government, is 8%. Payroll is 6%. And corporate income tax is 1.6%. And you can see how those are allocated. This opens up like, oh, corporations are only paying 1.6%. Oh, payroll is what is used to cover Medicare and Medicaid, and it's not covering enough, and we might be having
big discussions in the debate, by the way, and big discussions in election year.
100%. And yeah, this is where the numbers are showing up. Let's not talk about corporate taxes for a second, but let's talk about like payroll taxes and the amount spent on Social Security, Medicare, and Medicaid, because those cover each other. Social Security, Medicare, and Medicaid, which are a subset of the mandatory group, if we sum them up, they are around 5.4%. Hold on. 10.4% of the GDP. So those 3, Medicare, Medicaid, Social Security, are 10.5% of the GDP in terms of expense every single year. Payroll tax, what it brings in to cover those, is only 6%. So there's a 4% difference as a percentage of the GDP where those programs are costing us that much, and the income coming from payroll is not enough to cover it up.
The numbers show that it's unsustainable, which is why people
this
are
is
talking
showing
a lot
that
about
it is
this.
unsustainable, 100%, and policy has to make it. The reality for why it has become unsustainable is due to like a demographic shift, right? Back in the 40s, 50s, when FDR set all these in order, the demographics of the US were more youthful. We had the baby boomers right now were still in the workforce, which are the largest by population size. And now 50 years later, 80 years later, those people are retired. 50 to 80 are retired.
And they're retiring at a large, not only are they retired, but they're also retiring daily, weekly, monthly. The amount of retirees we have is growing exponentially because of the baby boomers, the size of that
100%.
demographic.
So those are retiring, and you do not have enough people in the labor market to pay up for the promised Social Security, Medicare, and Medicaid that those people were promised by the government. Unless in some miracle we just double our population or like increase it by a significant percentage, whether it is through, I don't know, babies or just a lot of immigration of skilled labor, that contribute to the economy, the problem will not solve itself unless you pump in labor. The other way to solve it is going to be through policy, and this is where the debate is opening up. You either increase the taxes, right? And who pays the taxes is a debate, right? Or, and this is what we've seen in other situations around the world. So if we want to take like the moral of the story, where have we seen it in previous places? It has recently happened in Europe, and it's happened a long time ago. What they would do is that they, instead of forcing people to pay more taxes in their payroll to fund those social programs, which is politically a hard move to do, what they end up doing is that they would extend the retirement age. So it happened like 2 years ago in France, right, where they increased the retirement age from like 62 to like 65. People demonstrated they were not happy about it, but this was the path of least resistance to actually extend the life and fix the numbers and make the books, clear up from a social security program.
Well,
so
what I was going to say too, Rabih, this actually makes sense too if we look at just the actual data. If you look when FDR put this program in place, you look at the average lifespan of an American then versus today.
Oh yeah, 100%.
Social Security, when it first came out, was more than a sustainable program because you were only on Social Security, if at all, when you quote unquote retired and actually started taking it. It was so popular because we had a couple of things going for us then. We had so many people working, like you said, and what people fail to, I think a misconception here is the current workers are paying for the retirees. It's a program that's happening like in real time. So when you have 16 or 17 workers to every one retiree in the 1940s, and their longevity is such that they're only living till their early 60s anyway, mid 60s anyway, or even, again, I think when that program was in place, the average lifespan was even earlier than what they said Social Security would be at 65, 62, 65. So you've got a youthful workforce. You've got a longevity at the time in the 1940s that you weren't having to sustain people on Social Security well into their 70s or 80s. You fast forward to today, we have such an older population and way less workers. I think it's something in the range of one worker to every two retirees. It's completely flipped as far as the demographics. So something is going to have to happen. This is why there's so much concern, which, by the way, I don't share the concern. I don't think Social Security is going anywhere, but they're going to have to make some changes for sure.
Yeah. So looking at these numbers and looking at the reality of the situation, it's contributing to the deficit every single year by 4%, right? I would not be surprised if the metric would be later on in a couple of years. This could be like a decade. It's not really happening tomorrow. We're increasing the retirement age, and guess what, Matt? You and I are not going to be retiring at 65. It's going to be 70.
Yeah. When we say retiring, we're just saying we're not going to be eligible to actually take Social Security.
Yeah. But if you have a financial advisor, you've saved enough, you can retire.
You're not going to worry about it. Yeah.
Right?
Yeah.
So from that perspective, this is where we stand on like the payroll situation as an income and Social Security, Medicare, Medicaid as an expense, and how those are in a deficit themselves, contributing to the bigger deficit. So we zoomed in to just talk about this case, but let's zoom back out again and just look at the deficit as a whole instead of going into certain programs and what policy might be there and what politics might say, because as Americans, we're going to hear a lot of these for the remaining of the year. So
we in America love getting political. We know that. Yeah.
It's healthy. Honestly, it's healthy.
Is it though? I don't know.
It's healthy. Okay. So we talked about what a deficit is, what debt is. We talked about their levels. We talked about what constitutes the inflow part of the deficit and the outflow part of the deficit. Let's talk about the deficit in historical perspective. We did mention that in the years from 1995 till from 1998 till 2001 there was a surplus. But let's look as a percentage of GDP for the past 50 years. So from 1990 and 1974 till now, what the average deficit has been. The average deficit from that time till now has been 3.7% of the GDP. So every single year, 3.7% of your GDP is being added to debt, and you're increasing your debt tally. And recently, the highest the deficit was in the year 2020. That's actually it's more probably an outlier. It was at 14.7%. So the average is 3.7%. But the deficit in year 2020 was 14.7%.
Massive outlier. We know. I mean,
massive
something
outlier.
Crazy. Something happened in 2020. I don't remember, but it was something big. Something with a virus or something.
I'm in denial. I just blocked that year. I don't know what happened.
Let's pull that year out. Yeah.
So but if we look at like 2022 and 2023, the deficit has been 5.2% and 6.2% compared to the long-term average of 3.7%. So we are running above the long-term average for our deficit, but not by like a big stretch.
So I want to, Rabih, really quick on this. I know we've talked about this before, but this is where I think we want to put the most context, or a lot of context around, because if you hear the media, and here's the other thing, we're talking about such large numbers. We're talking trillions of dollars, and it's really hard for our brains to comprehend this. But if you look at the media headlines, you hear people talking on the news about this. They play some games, right? Let's just be honest. They play games in regards to knowing the numbers are so large and people have a hard time comprehending it. So you'll hear stuff like the deficit is 100% larger than it was and they insert a year, right?
Yeah.
Or it's double what it was from 2019 or whatever. But let's just put that in context. We're talking about a historical average over the last 50 years, you said, of 3.7%.
7, yes.
And now
deficit.
We're running a deficit of 5.7 to maybe 6. I think we're just above 6 now, right? I just want to put that in context of like, yes, both things can be true. It is double the historical average, but we're still talking single-digit numbers compared to GDP.
Yeah.
So just kind of helping navigate and giving some context there. It's not as drastic. It's not as drastic as what the media is going to make it sound.
100%. And I'm just going to preface what I'm going to say now from this. I'm being like very politically objective, but it's because during election season, people say, oh, this president contributed to this much deficit and that president contributed to that much deficit. Let's just keep in mind that when a president signs a law or they pass an act into order, the lasting economic effect of those acts even sometimes goes on to affect the term of the next president.
Yes.
Happening. So the clearest example happening to my mind is like Trump passed the tax cuts in 2017. Great. Just from a stock market perspective, great. It was great. But those contributed to the deficit. We know it because they cut revenue. But those are still going to be in effect until the end of 2025. So those are part of like Biden's term. And for example, Biden did, the Inflation Reduction Act, where the reason they said it's inflation reduction because that bill per se, if you look at the numbers, it actually contributes to a surplus, just that project net. But this is just narrowing and looking at one thing. But the positive economic impact of it, the surplus of it, is not going to be seen for the next 10 years.
Yeah.
So if we have a surplus in 10 years from now, just because the government didn't spend a lot, which I doubt, is going to be because of, an act that was a net positive when it was passed. So just the fact that those acts and those laws have a time frame that does not overlap with the current term of a president makes it so hard to actually see whether a certain president per se contributed positively and negatively. And this is just talking about the acts they pass. We're not talking about external events that might happen, whether it was a pandemic or an inflation episode or etc. that requires intervention. I hope I was objective here.
That's such a good point, Rabih. And you're talking about something so much larger here of the issues we have in politics as a whole regarding this very thing. Is like you said, we want to give credit to insert any president. We either want to give credit to or blame to this insert whatever president over that 4-year period, as if everything's happening in isolation. So which is insane. Like you're saying, a lot of these laws and things that take place have such a long-term effect. Things that happened in the early 2000s, by Bush, let's say, had ripple effects for 5, 10, 15 years after. But again, it's so difficult. And on top of that, you've got both parties fighting each other and going on these debates saying, well, during this presidency, they did this and this and this. Yeah. It's very difficult to navigate. That's why I like that you gave that context to say it is not that simple. A lot of these things. That's the noise. That's the noise. That is the noise for sure. You've got to dig deeper, which the media is never going to have you do. They want to keep it very surface level and act as if that president operated in that 4-year period and all the results happen in the same time frame. That's just not how this works.
100%. So this brings us, I think, to the last 2 points that I want to share with you. So we talked about the deficit, and we said that it is This year it's been 6%, and 2.4% of it is net interest. If we want to make an analogy to a dental practice or just an individual who is saving, and think of it from the lens of the quality of your debt, right? We know that dentists graduate dental school and then they open a practice and they have debt on them, and they can just live through that debt just because they can service it. And in that sense, just because it increases their net worth later on because they are, beneficial investments, they increase their net worth. We say they are good debts. And all the companies that are on the stock market, and let's talk about the S&P 500 companies, all of those have debt on their balance sheets. It's not like, oh, we do not need to have debt, because debt is what allows you, it's the cheapest way, one of the cheapest ways to fuel future growth. And
I think it is the cheapest way. Yeah.
It is the cheapest to fuel economic growth, and that's why it is prominent and people take on debt. So if we want to think of it from the perspective of the government, you have a client called the government, Matt, and that client is telling you, oh, out of the debt that I go into every single year, a third of it is just to service previous debt. How much would you be worried?
I mean, I'd be a bit worried. That's a significant chunk that's not helping for expansion or growth or innovation. It's an anchor. It's an anchor on your balance sheet for sure. So I mean,
okay.
A third is a significant sum. Yeah.
A third is a significant sum. Probably, definitely if it's a human, but probably not for a government.
Yeah,
that is something sure. we can think of. But there is still 2/3 just for us to invest in projects that would allow us to grow out of that debt going forward.
Yeah.
Right. So that debt has been accumulating every single year, and now the debt is as of 2023 is 27 trillion. Let me give you the exact number to the decimal.
It's like our brains can't even comprehend this.
27 trillion, which is 26.2 trillion, I think. And that number, if we put it in a percentage of GDP, is 97%, which is a big number. You are saying it's the equivalent. When we're looking at total debt, we're not looking at your debt rate and how much debt per year. We're not looking at it from a cash flow perspective. We're looking at it as a balance sheet perspective. If your GDP is the asset, let's put it that way, you have as much debt as you have assets, because your debt balance is 97%, which is a big number, especially for humans. But also, if you are starting right out and you bought a house and the house is not worth is bigger than yours, like we've been in those situations, and banks would be only worried about the fact whether you can service that debt or not. Governments, now the U.S. government is at 97% debt to GDP ratio. It's going to be hitting the 100 very soon. I'll just tell you, I've been doing a lot of research on this. There is no number or a cliff where if the government has over 100% debt to GDP, then we are going down in shambles. I didn't know this, but I learned it later on in some economics classes, that in 2008-2009 there was the study that Paul Ryan in the House just held up and said above 90% debt to GDP, economies default, etc. We dug into that research lately, and the numbers don't add up. There's no statistical significance. So unlike a human or a business, because you can only work enough, or you can only capture enough market share or dental patients in the market, a certain amount of debt compared to your assets should not be the indicator for whether you should stop taking on debt. The only important factor is whether you can still service it. And given that you still have 2/3 of the deficit every single year to be able to grow yourself out of it, puts the US in a position where, yes, this is trending in the wrong direction, but this is too far away. So the idea is we're heading to 100% debt to GDP level. We're going to be hitting a wall pretty soon. Not really, because in terms of the revenue that's going into the U.S. government, it's the highest it's ever been, simply because our payroll taxes, our income taxes, even the corporate taxes are at an all-time high due to the U.S. consumer and U.S. corporations being the richest they've ever been in a while.
Yeah.
So while there are signs of heading in the wrong trajectory, there is a very strong bed frame or like a pillar of a healthy potential to bounce out of it. And if we look at the US history from what's your potential to bounce back out of it, we're better than when we were during the war and Second World War, and the debt to GDP ratio during the Second World War were around like 109, 110% of GDP.
So there's so much here. There's so much good stuff here, but that's what I was going to reference too, is to that Paul Ryan reference of that study. This is not unprecedented. We saw this in the 1940s, post World War II, a higher debt to GDP ratio, as you just mentioned, over 100%, right? And we grew out of it. So just for context there, anyone, again, the news, and you talk about political debates and going back and forth, each party throwing out, let's be honest, a lot of crap. That's just the truth. Like they're using either half truths or conjecture, or just not full context and not going into the nuance, because they can't really in a debate when they're throwing zingers and one-liners at each other. But the truth is, and this is not, by the way, this is just to be fair, neither one of us, Rabih, are saying that right now this is a good thing to continue to take on debt. We're not claiming that's a good thing. I think what we're saying is trying to give some information, trying to give some context, and saying this is not unprecedented. This is not as crazy as what a lot of people are saying. And I love, this is the other part. You've said this a couple of times. It's different than a human. I think this is where a lot of people get confused, where, and again, it makes sense. We're likening, when we talk about the debt in, again, media or radio or whatever, and they're talking about the debt, we immediately think or put it into context of like our own situation or just a person's situation, and saying, man, you can't take on that much debt as a person. But a government is completely different. And again, we are not saying it's a good thing. We're trending in the wrong direction, but we would not be being fair to the discussion if we did not highlight the difference between a government versus a human taking on debt with a terminal endpoint of their working career and their life and their ability to service that debt. Very, very different than a government who it really theoretically it has in perpetuity to service debt. And the key factor here, as long as they're growing, as long as that government continues to grow and bring in those revenues and has the taxation power that they do, it's not as egregious as it would be a human taking on that level of debt to income ratio. Is that fair to say?
Yeah, I really love that you hit the perpetuity part, because the reason humans can't take on a lot of debt is because, you're 50 years old and you want to take, I don't know, $2 million of debt on you, but you're going to be dying. Who's going to guarantee it to it? For me as a bank, this is bad business for me. But for a government, it can just, the next generation is going to be paying for the debt, and the generation after and the generation after. So in a sense, if you are a human who will never die, I don't think the bank would worry about you not paying back. They'll just extend it.
Yep.
As long as you can service the debt, as long as you do not default, as long as you do not put your situation where a situation where inflation spirals out of control, right? Because that will harm the quality of the debt. As long just borrow and then service it, as long as you can keep the commitment of servicing it. This is what monetary system is. This is what the dollar is. It's just a legal tender that you're going to be paid back.
Yeah.
Right. So this is how the system is built, and there is no upper limit, as simply because governments and countries run in perpetuity.
Yeah, and to your point with the Paul Ryan study, wherever that came from, the truth
Actually,
is,
it came from Harvard.
Oh, came from some school named Harvard. But the truth is, right, we actually don't know that upper limit. Like, nobody does.
Yeah.
And I think
we don't have enough data. So I was reading other studies about it. Even in one of like my a PhD class I was taking, we were looking at it. All the countries in the world, with how long they have reported their debt levels, we do not have enough data to see an actual trend that is statistically significant. For those who want to nerd out with me on this, there is no trend that above a 90% debt to GDP ratio, you create a negative relationship between debt and growth. There isn't.
Yeah. So, but this is so interesting, and the psychology of this is so interesting that we don't want to hear that, right? Like even me, I'm sitting here saying, like, I don't want to believe the truth that we like which is that. So the truth is, the answer is we don't know. We actually don't know. We want a story that makes sense, which is again why I think we take these things and place it in the context of a human, saying, well, if a human took on this much debt with a terminal endpoint of their life, right? At some point, their life's going to end. They can't service the debt. That makes sense to us. So this is why this is such a trigger point for people when we're like, oh, the government's taking on all this debt. We can't sustain this. We can't sustain this, because that story makes sense. But the truth is, we don't know. We actually don't know. And that's why the government has not blown up. The country has not blown up, even though we're running at such a large deficit and such a large debt load. Because again, we continue to grow, continue to innovate. By the way, we haven't even talked about something we talk about on 2 cents all the time. I can't believe we haven't brought it up yet, which is our favorite word, inflation, favorite topic. But that is in some ways, or that is a huge impact here. And if you think about the government running all this debt, inflation is actually helping the government. It's actually making that debt cheaper, right?
Yes. Here are the mechanics of it. When you take on debt, let's simplify it back to a human. You have a mortgage, right? And the mortgage is set, let's say your mortgage is only 500K. This is it. Whether there is inflation or not, that mortgage value is going to be 500K and you're going to be paying it down the road. However, if you are in an economy where there is inflation, you as an associate in a dental practice are going to go to the dentist and tell him, I need a raise that keeps my living of standards equal to inflation. And if inflation is 10%, you're going to be getting 10% more money every single year. That 500K is staying the same, but your salary in nominal terms is increasing due to inflation.
Yep.
And in a sense, you're deflating the debt away. So actually, inflation is just a way of deflating debt away, and it is showing it is a reflection of a lack of trust in the government being able to pay its obligation. And this is what inflation is. It's just any legal tender's value is going down, including the currency.
Yeah, which that explains why when we say debt is one of the cheapest way, if not the cheapest way for an economy or a business to grow, especially, and this is the key point, when you have expectations of consistent revenues and growth, right? So this is why a business would take on debt at a fixed rate, right, over a period of time if they have a high expectation of growth. So take a dental practice, a high expectation of like consistent cash flows and growth. Debt is not a bad thing, because let's say to your point, Rabih, you have a payment on your business loan, your practice loan of $5,000 over the next 10 years. Well, that's going to stay the same over the next 10 years. $5,000 payment in 9 years from now is way cheaper than it is today. Way cheaper.
100%.
So again, 100%. If you
100%.
continue to grow, debt is a great way to continue to grow that business in a very, very cost-effective way, with inflation even going at let's say, an average historical rate of 3.5%. That debt continues to become cheaper. So we nerded out, Rabih. What are the thoughts on this, if any? One thing we talked about that I don't think you hit is, that I think is important context.
Cost of interest.
Cost of interest. I wanted to hit that as well.
Yes. So just like how inflation dissolves the debt away, the interest rate in the economy set by the Federal Reserve, because according to our constitution, like the Federal Reserve is an independent institution than the government. They might go at each other. Yeah. They might go at each other. In other countries around the world, they're not independent. But in the US, they are independent. And just because the Federal Reserve job is their dual mandate, price stability, which is inflation, we just talked about it, and full employment, they control interest rates. And the government, just like any other legal entity in the economy, has to borrow at the current interest rates. So something to look at is like, okay, us as just general consumers, it's been harder to buy a house because now the mortgages are at 7% versus the 3% they were a couple of years ago. How much is the US government being hurt by this interest expense? And will that net interest that is 1/3 of the deficit going to be increasing just because they increased interest rates? And I found some data, and it's actually very fascinating. So back in, and just to so that deficit, that difference that you have to take onto debt, the government takes it in the form of issuing bonds. So they either issue treasury bonds, which are over a 10-year maturity, treasury notes between 5 to 10 years maturity, or treasury bills, which are less than a year. And you've got floating rate notes and inflation protected securities, et cetera, et cetera. So this is how they make up for that difference in the deficit. And absolutely and definitely it makes sense that the short-term maturity bonds like treasury bills are going to be, because they are issued for very short term, are going to be at a higher interest rate. They are not locking in the long-term rates, similar to how a person who bought a house in 2017 locked in a lower mortgage rate, right? So for treasury bills and like floating rate notes, etc., the government is paying 5.3, 5.4% on these, right? But for their treasury bonds that are very and notes that are really old, they are paying 3% on these, and they will keep on paying 3% on these until they mature. So if you aggregate all the debt, this $27 trillion of debt that the U.S. economy has, what interest rate they are paying on, and it's not really the 5% yet. It's right now at only 3.27%, which is a very low interest rate historically, even for the government. Pre the interest rate hikes right after COVID, the government was paying 1.7% on its debt, but now it's 3.2%. But this is still a very low percentage compared to how much interest payment, like interest expense as part of the debt, the government was paying in the 70s. So it is different.
Yeah.
It's very different.
So let me
it has pros and cons.
Let me summarize that back to you for just to make sure people understand again what you just broke down. The government issues bonds in form of whether and there's different terms, there's different lengths of these bonds to cover the deficit, right? This is how they're putting these bonds out. They're gathering money from who's ever buying these bonds, individuals, corporations, family offices, other countries, whatever it is. People buying these bonds, they're gathering revenue to help support or cover that gap in that deficit. But you're saying the old debt they issued 5, 10, 30 years ago is still being serviced at those fixed interest rates.
They locked it in.
So now rates are up. So people are freaking out because they're saying rates are up. The government can't like now it's becoming that much more expensive for the government to pay this debt, which is true, right? But because we had such a long period of time of low interest rate debt, that is the majority of our debt right now the government is carrying. So it's not as big of a deal right now because rates are up, it's not that simple, is what you're saying. We have a lot of debt on the balance sheet that is really reasonably rated, or a really reasonable rate that the government's paying off at, like you said, still historical low rates. Even as you factor in these higher rates we've seen recently, it's such a short period of time that the aggregate interest rate on our total debt is still only 3.7%.
Yes.
Is what you said?
Yes.
It's so sustainable. If you factor in inflation, like we just broke down, at a historical average of 3 to 2.5%, 3%.
In real terms, they're not really.
The
paying.
debt is really cheap, really cheap. So okay, that's good to know. So was that a fair summary of just saying?
That is a fair summary.
Okay.
Yeah.
I think this is good context. Hopefully, it's good context for people to take a deep breath and say, the truth is we're not trending in the right direction. We acknowledge that, but it is not as catastrophic as what the media is going to make it sound.
And it is resolvable. It's
Very
not like
resolvable.
at a point of no return. We're not even near a point of no return.
Look at us navigating the noise, Rabih.
Just navigating. Like, I really loved what you said when it's like, we really don't know. And we really don't know because the economies trend in every single day. The news about the economy is like unprecedented times.
Yep.
It is unprecedented times. But if we know one thing is that a debt is a promise to pay the other party. And as long as the U.S. Upholds that promise, no matter what the level is, no matter what inflation is at or interest rates are, the wheel will keep turning.
Yep. Love it. And what I say a lot, and I fully believe this, anyone who says they know on things like this is either lying to you or trying to sell you something.
Or is asking you for your vote.
Or is asking for they're lying to you or trying to sell you something, like even for your vote, right? Like anyone who wants to take something that is so wildly complex, and we're sitting here saying, I'm sitting across the Zoom screen of a future PhD, and truly someone who knows this stuff inside and out better than most people out there. And we're both sitting here saying, oh, and then I'm here as well, but we're sitting here saying, we don't know. Like, we don't know. We are saying that, but we're trying to give some context to say, again, this is not as insane and as catastrophic as what the media wants to tell you. The media wants one thing, which is your attention. And so they're not going to sit here and talk about the truth and the nuance and the fact that, and give you the context. They're not going to give you the actual data here and say, hey, this is not unprecedented as far as debt to GDP ratio, give you the actual like aggregate interest rate, talk about how inflation impacts it. They're just not going to do that because, again, they want your attention. They want you to click. They want you kind of freaking out so you come back. So hopefully this is helpful in giving you some of that context. So Rabih, I want to give you final word. Any other thoughts on this or comments on any of it? We went for a while on this. I knew it was going to be a big topic.
It is going to be a big topic. Honestly, I enjoyed it. So thank you. I'm hoping that, I don't know, people will listen to this whenever they feel like they've been bombarded with a lot of, especially this year, a lot of like opinions and a lot of accusations left and right. And it's like, okay, let's look at numbers. And then I will use these numbers to make my own decision.
Yep.
Whatever it is.
Love that. Great final word there. Just basically turn off the news and listen to 2 cents. That's what we're saying.
Yep.
That's what we're saying. Awesome. Rabih, thank you so much for the incredible work you did on this. And you did a lot of deep dive, a lot of digging on this to bring these numbers and to bring this context. So really appreciate you. Thank you everyone for listening. As always, that was our 2 cents. Till next time, enjoy the weekend. Bye-bye. Happy birthday, America.